Again, thank you for a wonderful introduction there. And it's a title that I have expanded upon probably excessively. I hope that I get through in less than my allotted time. But as much as Jacob said, I was inspiration for, and also managed to waylay you. Hyman Minsky was mine. And so my final tribute to Minsky was to name the software package that Jacob mentioned after him. I thought no better way than to continue keeping his name in the profession than to name a software package after him that I hope will expand over time and become a standard for students doing dynamic modelling and economics. And of course a major part of that is also called Godley tables after Win Godley.
Microphone, please.
Oh, pardon me. Is it not working properly? Is that better? Okay, sorry about that. I'll just move. I can tell myself that's better. So I move closer. Okay, well, if you look at the conventional literature, of course, this is a very common refrain from neoclassical economists. First of all, when they said no such thing was possible, after it happened, they said nobody could see it coming. And one of my favourite retorts here was actually made by rather a significant person, the Queen of England. And she's famously reticent. She rarely says anything in public. I'd love to hear what she says in private. But she did say this in public, I think at the London School of Economics. She was being given a presentation on the financial crisis. And of course, she's someone who suffered quite substantially. Her portfolio fell by about 40%. I'd like to have 0.4% of her portfolio, but it was a significant loss in wealth. And she asked, I wish I could imitate her plum English voice, but she said, if these things were so large, how come everyone missed them? Why did nobody notice it? Of course, there was absolutely no answer forthcoming from the neoclassical economists there, apart from saying, well, we all thought other people were looking at it, and we must have all missed it together. And her response to that was to say how awful it was. And, of course, when you look at what neoclassicals were looking at, they were focusing upon falling inflation and falling unemployment, and thought it was wonderful, and were saying it was all due to their magnificent management of the economy. What they were ignoring was the factor that Minsky pointed me at, and also the post-Keynesian literature looked at, a rising level of private debt to GDP. Now, if you take a look at that, then rather than being something which was not possible to see, it was as obvious as the nose on a swan's face. It wasn't a black swan at all. It was a debt-driven boom followed by a collapse, and it's the second one we've had in 100 years. If you go back to the 1920s, you find the same pattern the neoclassicals were raving about now as being due to their good management of the economy, which was a period of declining volatility in employment and inflation. The 1920s, of course, was affected by the movements in and out of the gold standard in terms of the rate of inflation. That's why you had that massive deflation back in 21-22. But the same story applies there. Declining cycles in unemployment, and by the beginning of the crisis, the unemployment rate, as the NBR recorded it then, which is really simply people registering for unemployment, to record themselves as officially unemployed when looking for a job, fell to zero. Then it grew to 25% unemployment. Of course, inflation fell down to minus 10% for a couple of years. This is the more recent data the neoclassicals were raving about until the crisis hit. Declining cycles again in inflation and unemployment, and then, so far as they're concerned, without warning, an explosion in unemployment and a decline in inflation from +5 to -2%. We tend to forget that particular phenomenon because the rate of return to moderate inflation was fairly rapid, I think largely under the influence of the rescue projects that the American government threw itself into in sheer panic at this event. I've spoken to a couple of the leading characters involved in the Bush administration at the time, one being Edward Lazaire, who was Bush's economic advisor when the crisis hit, and he basically described the mood inside the Bush cabinet as sheer panic when the crisis hit. So they threw everything they could. All the neoclassical constants went out the window. They did not want to be the people on whom the collapse of capitalism could be blamed. Okay. So hence a return to inflation. But of course, over time, we've trended back down towards deflation. Now, what was missed by the neoclassicals back in the 1920s, and it's still missed by them today, was that in both crises as well, there was a rising level of private debt, followed by deleveraging by the private sector. So we tend to focus on the ratio of private debt to GDP and see this explosion in private debt in America, but that was caused by deflation. And at the time, the Americans were actually reducing their debt levels, but the GDP was falling much faster than they were reducing their debt, hence the ratio rose, which is one of the phenomena that Fisher identified. This is the more recent data, much more carefully recorded. This is ever since 1952. America's been keeping excellent records of its private debt. And from 1952 on till 2008, the level of private debt was rising. Even periods when the ratio fell, it was because GDP was growing more rapidly than debt for those brief periods. But throughout the whole period, rising private debt until the crisis, when the rate of growth of the debt slowed down, a period of deleveraging, and then back to leveraging again right now. So the ratio reached a peak of 170% of GDP and is now down to about 145%. So these elements of excessive private debt and deflation, and also disequilibrium, were essential parts of the way that Irving Fisher attempted to explain the Great Depression. Of course, he was famously the person he was the Paul Krugman of his day back in the 1920s, because as well as being a very famous neoclassical economist, probably the most famous of his time, he was also a columnist for the New York Times. And he wrote that famous comment saying that the market appears to have reached what looks like a permanently high plateau. That's normally what most people know about what he said. He also added that he doubted there'd ever be a 50 or 60 point break in the index, such as a bear commentator called Babson had predicted at the same time. Of course, within weeks of him making that comment, the market fell by over 50 or 60 points. But looking back on it, having been financially wiped out, having his reputation ruined by this massively wrong prediction published in the New York Times, he then developed the debt deflation theory of Great Depressions. And neoclassicals, when they read this, completely miss the fact that disequilibrium played a huge role in Fisher's explanation. So he started by saying perhaps we can assume that variables tend towards equilibrium. But the exact equilibrium is seldom reached and never long maintained, because there will always be shocks. Now, rather than making those shocks something around an equilibrium pattern, which is what neoclassicals do today and what they laughingly describe as dynamic stochastic general equilibrium models, I regard them as neither dynamic nor general. They're stochastic equilibrium models. But what Fisher argued was that because of the shocks, you are going to be out of equilibrium. Therefore, the behaviour of the economy will always be driven by disequilibrium, and you have to take that into account. Neoclassicals don't even see that when they read Fisher. So he said, theoretically, it must always be under-production or over-consumption, under or over everything else, and in a phrase rather similar to Keynes's about in the long run we're all dead. He said it's as absurd to assume that the economy will be in equilibrium as it is to assume the Atlantic Ocean will ever be without a wave. So disequilibrium was essential there, and the key disequilibrium events he focused upon were over-indebtedness followed by deflation. He said, so the big bad actors are debt disturbances and price level disturbances. Now, Fisher simply accepted that could happen. He didn't explain how it come about. And if you look at Hyman Minsky's development over time, he did not understand or know Keynes when he first started working on his theory. He only read Keynes's General Theory of Employment, that short 15-page paper that was Keynes's summary of his general theory, which he published 2 months before Hicks wrote his totally distorted Mr. Keynes and the Classics as an alleged summary of Keynes. Only when Minsky read that, and sometime in the mid-60s, did he realise that Keynes wasn't what he read in the textbooks. But before that, he'd read Fisher. So he was trying to provide a systematic explanation of how you could get to this position of over-indebtedness and then have a Great Depression occur. And that's the intellectual framing that he made for his whole approach to economics, was to explain, can a Great Depression happen again? And if it can happen, why hadn't it happened since World War II when he wrote? And he said to do that, you have to have an economic theory that makes Great Depressions one of the possible states a capitalist economy can find itself in. And of course, neoclassical economics is defined in such a way that crises can never occur. There can be exogenous shocks, but you'll always return to equilibrium. So Minsky's vision, rather than seeing capitalism as an inherently equilibrium-driven system, he saw it as inherently flawed, being prone to booms, crises and depressions. And this is not something he thought you could reform away, and this is something I've come to appreciate more over time. He said this instability is due to characteristics the financial system must possess if it is to be consistent with full-blown capitalism. Such a system will generate signals that induce an accelerating desire to invest and finance that accelerating investment. I think that's absolutely crucial. It's not something you can reform out of existence. You have to simply take it into account, which of course we haven't done. So he called that the financial instability hypothesis, and in this, cycles, debt and non-equilibrium are at the absolute centre of his thinking. We wrote, and this is something which, again, I think I absorbed this before I properly understood it, and I think I understand it properly now, is that the natural starting point for analysing the relation between debt and income. Now notice that, a relationship between debt and income. That is still something that hasn't percolated itself fully even into the post-Keynesian mindset yet, let alone neoclassical. There is a relationship. Minsky felt it, he couldn't quite explain it fully. But he said you have to therefore to understand that relationship, which he took as implicit, you have to take an economy with a cyclical past that is now doing well. So a cyclical model was also essential. And he said that you have inherited debt levels reflecting the history, which includes a period where the economy did not do well. And therefore liability structures and people's willingness to take on debt has a large margin for safety given that previous crisis. But over time, as the economy progresses on from that crisis, people realise that debts were easily paid and it paid to lever. So a period of stable economic growth and stable performance led to rising expectations. And that's what he sees as the fundamental instability in capitalism. A period where the economy does well, people change their attitudes towards debt, and that propels changes in the actual nature of the economy. So you have an increasing weight of debt finance, and the economy is transformed into a boom economy, so a period of tranquil growth becomes a period of speculative excess. And therefore stable growth is inconsistent with the manner in which we finance investment in a capitalist economy. And I think this is one of the most insightful sentences ever written in economics, because so many, the mainstream sees the economy as fundamentally driven towards equilibrium. A lot of critics of capitalism talk about it being an economy driven to stagnation, so that the Marxist argument about a declining tendency for the rate of profit to fall, all these stagnationist theories you'll see. Minsky, on the other hand, said the fundamental instability of a capitalist economy is upward. The tendency to transform doing well into a speculative investment boom is the basic instability of a capitalist economy. I think it's incredibly insightful. And that's a non-equilibrium process. So to still Minsky's theory out step by step, we start with an economy in historical time. Of course, those are two elements which are left out of neoclassical thinking. They pretend to do time, they don't do it at all, and they've been responsible for shutting down history of economic thought and economic history courses around the planet. So they don't learn from history and they don't understand time. We start in historical time, so consider yourself back in the aftermath of the 1990s recession, which led to Bill Clinton taking power in America. There was a debt-induced recession in the recent past. That was the savings and loans crisis and the aftermath of that, and of course the 87 stock market bubble. That led to firms being conservative about the amount of debt they'll take on, so only conservative projects got funded. Some of those would have been in telecommunications. But because the recovery had occurred, most of those projects succeed, and therefore firms and banks revise their risk premiums and accept a higher level of debt to equity and start to value assets more highly. So rather than this being asymmetric information, which is the way neoclassicals attempt to interpret some of what Minsky argues, this is symmetric beliefs about an uncertain future. Both sides of the borrowing equation share expectations, they both move in the same way, they reinforce each other. It is not a case of lenders loaning less than borrowers and therefore too much debt being extended. Both sides are willing to take on more debt as the boom goes on. You then have self-fulfilling expectations. The decline in risk aversion causes more investment, that causes the economy to grow faster. Asset prices rise, so people start to make money on a rising market. And the willingness to increase, to lend increases the money supply. Of course, endogenous money is an essential part of Minsky's thinking. As that goes on, you get what he called euphoric expectations. And this is where Ponzi financiers become feasible. Ponzi's being basically defined as so-called investors who have a cash flow from their investments which is less than their debt servicing costs. So fundamentally, they're always bankrupt. The only way they survive is by selling assets on a rising market. And before the assets are sold, they desperately need to take on more debt to finance their losing positions. So they have a totally non-elastic demand for debt. They must borrow, otherwise they go bankrupt. And of course there's also a timing issue for them which can bring the economy a cropper later on. So you have a profitability from asset speculation, reduces sensitivity to debt and also interest rates. can drive up both the supply and the demand of finance, can lead to market interest rates rising, but you then have a whole range of changes in the economy as the economy goes into a boom. Income distribution shifts, wages rise, cost of raw materials can rise as well. That can undercut people's profit expectations, and you'll have that causing firms that are making a profit to find they're making less than they expected. Ponzis are necessarily losing money. If they can't roll over their debt at some point, out of the blue they can have a total collapse, and that can cascade through the economy. And the euphoric investments people were undertaking can fail. You also can have rising interest rates, and of course the Federal Reserve can intervene and make things worse because it doesn't understand capitalism. So all this comes together and you then have a crash. The Ponzis are normally the first ones to go bankrupt because they can't sell assets for a rising market anymore, and suddenly all the banks that were willing to lend the money before the crash occurs won't even look at them after the crash occurs. You have a collapse in asset prices, increase in debt-to-equity ratios, the money supply goes into reverse, investment evaporates, and you're back where you started again, which really is leading our story from 1992 through to 2007. Now, what happens next depends upon the inflation rate and the size of the government sector. So if you have a high level of inflation, which is like back during the 1970s, then the debt is ultimately repaid by a rising price level, but investment is low, so you get stagnation. And that's a Minskyan, Keynesian explanation for the stagflation period, which, of course, Friedman's allegation there was no Keynesian explanation for stagflation is part of how the whole neoclassical revival began. But you'll get back to cycles again once the debt levels revived, and we saw that happen, of course. But low inflation, like the 1930s and like now, the debts can't be repaid. A chain reaction of bankruptcy can affect even non-speculative businesses, and you end up in a depression. On the other hand, if you have a big government, then anti-cyclical spending can enable those debts to be repaid. But unfortunately, you live in Europe. Okay? You have the ECB, which won't allow you to do that. So you end up in a depression. Okay? But America goes back and continues on with the renewal of the cycle. Now, Minsky didn't provide a mathematical model, partly because he actually, though he's trained in mathematics, he didn't actually do the proper thing in analysing the foundations of the multiplier accelerator model he was working on. If he had, using not the characteristic equation approach, which is all most economists learn, but using matrix conversion of the model, he would have realised that it had the multiplier accelerator models are invertible. The matrix is invertible, which means it's not a genuine model at all. I knew that, so when I did my model back in 95, it was actually published in 95 but written in 92. It took 3 years to get through publication of the Journal of Post-Keynesian Economics. I used Goodwin's growth cycle model, and that was a two-equation model in continuous time where the two system states were the employment rate and the wages share of output. And all I added effectively was the third dimension, private debt to GDP. So I read it back in 92, and what I saw in the model when I first plotted it was this remarkable pattern. The bottom of this box, the axes are the employment rate and the wages share of output. The vertical is the banker's share of income, which is fundamentally driven by the debt to GDP ratio, because I didn't have a variable interest rate in that particular model. And I was stunned by it, and so was one of my, not advisors, but one of my close colleagues at my university, Eric Soe. And Eric's reaction when he saw that model was to say, Steve, if you've uncovered anything that actually exists in capitalism, we're in deep, deep trouble. And only over time I realised how right he was. I just thought it was a good reason to finish my paper with a nice piece of rhetoric. And I said the chaotic dynamics in this paper should warn us against accepting a period of relative tranquility in a capitalist economy as anything other than a lull before the storm. This was not a verbal prediction of Minsky's. It was something that only was uncovered by this mathematical model. And I thought it was literally just an interesting phenomenon, but then fundamentally it happened. We had what neoclassicals call the Great Moderation, followed by the Great Recession. And I'll show you that what both the model and I think the real-world data shows as well is a phenomenon from complexity theory called the inverse tangent route to chaos. So this particular element of chaotic behaviour may be a fundamental feature of capitalism, which is why we've seen it in the two crises we've actually had. So I derive the model in a different manner, but you can actually derive it by starting from strictly true identities, and this is something I encourage not new post-Keynesians to start working from. Start from something which is strictly true, and then model that with the simplest possible structure. So the identities that my model can be derived from are that the employment rate will rise if economic growth exceeds the sum of growth in labour productivity and population growth. You're talking the percentage level of unemployment. And that's just they're straight facts. Those are basically expanding identities. The wages share of output will rise if wage demands exceed labour productivity. And the private debt to GDP ratio will rise if private debt growth exceeds the rate of economic growth. Those are three straight-out identities. So putting them in symbols, I use lambda for the employment rate, omega for the wages share of output, and little d for the private debt to GDP ratio. So there's your employment rate. That's the rate of economic growth. And that's the growth in labour productivity and population growth. And then similar for each of these other elements. So there's wages share of output, wage demands, growth in labour. Then the debt ratio includes the private debt to GDP ratio, rate of growth. And just to fill out those equations in more detail, the rate of growth of the real economy is just 1 over YR dt. Alpha is the rate of growth of labour productivity. Beta is the rate of growth of population. Wage rates, I'm simply saying what the... I'm not giving any Phillips curve expression here. It's simply saying that is the rate of growth of real wages. And the debt ratio, that is the little big D is the rate of growth of private debt. So those are the elements there. At this stage, it's not a model. It's a set of identities which cannot be disagreed with. It's absolutely true. When you put them into a model, you get both the Great Moderation and the Great Recession coming out of it, and rising private debt and rising inequality. All the phenomena we've actually seen in the last 30 years. So the simplest possible model has output as a linear function of the capital, investment a linear function of the profit rate, employment a linear function of output, and wage change a linear function of the employment rate. Of course, the world's more complicated than that, but that's all you need to generate these effects. And then finally, for change in debt, I have that being equal to investment minus profit. So this has no government sector, no Ponzi finance, and no bankruptcy. And as Yanis Varoufakis once put it, this is a model of capitalism which would be, for an Austrian economist, not the ones in the room obviously, would be an Austrian economist's wet dream. Okay? No government, no Ponzi finance, and you can't go bankrupt. You've got to pay your debts back. That's autoliberalism, isn't it? Okay. Well, I have here output as being capital divided by a capital output ratio. Investment a linear function of the profit rate minus depreciation. Profit being net of interest payments and wages. Employment just simply divide output by labour productivity. A linear Phillips curve. And the only way in which money is used is to create new factories, which you would think would mean no problem. Well, you get a very simple model out of this. This is just doing the straight linear model of and putting all the terms out here now. So I've got three variables, which are the employment rate, the wages share of output, and the private debt to GDP ratio, and 9 parameters. So it's a pretty simple model. You wouldn't expect complicated behaviour from it. But you get complex behaviour because a key phenomenon of complex systems is that once you have 3 equations or more interacting in a non-linear way, and the non-linearity here is due to the interaction of variables. It's not non-linear behaviour, it's lambda multiplied by omega and things like that. That can generate complex behaviour. That's the Lee-York thesis and also Robert May's work back in 1976. And the particular chaotic phenomenon we see here is known as the Pommeau-Manivelle or inverse tangent route to chaos, which was first used to explain a transition from apparent laminar flow of fluids to turbulent flow in both the Lorentz model and in actual fluid dynamics. And what you get is a period of diminishing cycles followed by rising cycles and then turbulence, and I'll show you that in a moment. So if I solve the Goodwin's model with a linear Phillips curve, that's your equilibrium level for employment and your equilibrium level for wages share of output. The remarkable thing about bringing in debt into the system is that I get 2 of the 3 same equilibrium statements. So the equilibrium for employment continues on, and we have equilibrium for debt, which is a very complex expression, as you can see. But notice wages share was the equilibrium term up here. It's the profit share that's an equilibrium down here, not the wages share. So wages share ends up being a residual negative function of the profit share, which fluctuates around or near an equilibrium, and the debt ratio. So a rising level of debt means a declining of share going to workers, and that's despite the fact that there's no borrowing by workers whatsoever in this model. So fundamentally it's workers who pay for higher debt, even though capitalists are the ones doing the borrowing. And that's, I think, a structural explanation for the rising inequality we've seen in the last 20 or 30 years that Piketty has identified. So we've gone from a two-dimensional system to a three-dimensional system. And you can get two possible outcomes. You can either converge to an equilibrium, or you can have apparent convergence followed by non-equilibrium breakdown. And that was, as I said, first observed in fluid dynamics. So the way that it was modelled by Pommeau and Maniville is using what's called a Poincaré map, where you converted continuous time model into movements through a slice of the three-dimensional phase space in discrete time. And it's effectively showing the movements between, I'm trying to get my cursor to turn up on the screen here, movements between a straight line and a curve. Now, if the straight line cuts the curve, then there'll be 2 points of equilibrium, one down here and one up here. The lower one will be stable, so you go from turbulence to stable flow. The one up here will be unstable. You'll go from turbulent flow to more turbulent flow. But if you have this point of tangency, or the curve doesn't actually touch, what you have is diminishing cycles, looking like you're going from turbulent flow to laminar, and then on the other side you go back to turbulence again. So that's that fluid flow dynamics. And that's what we actually find in capitalism. We had a period of apparent stability leading to breakdown. So if I graph a simulation of my model, this is where the parameters are set up so that I get a convergence to equilibrium. So the employment rate fluctuates, and then the fluctuations dampen over time. Profit rate does the same thing, fluctuating around an equilibrium, dampening over time. The debt level rises but also reaches an equilibrium. When you graph that in 3 dimensions, this is the stable process. You get converging to that bottom equilibrium. But if you have different parameter values, so that the capitalists are more reactive to the rate of profit fundamentally, what you get looks like diminishing cycles, but then they start to rise again. So that's the employment rate. That's the profit share of output. And the debt ratio dampens down at cycles and then rises on the other side. When you graph that in 3 dimensions, and remember this is all with linear behavioural terms inside it, you get diminishing cycles and then expanding cycles. And that's, I think, the fundamental instability of capitalism Minsky talked about. That's it there. Now, when I model it in 3 dimensions, as I said, you get those two possibilities. So I'll show you, given the amount of time, the amount of detail I'm going through, I'll bring up the Minsky model and show you it running dynamically. So this is set up, first of all, is a set of straight differential equations. So at Minsky you can see the equations as you write. That's the equations I've just explained to you a moment ago, and that's the model. If I simulate it, then you get cycles that diminish and ultimately reach an equilibrium. Okay. But if you start with a more reactive capitalist class, so they invest more money, given an increase in the rate of profit. And this is now showing it as a flow chart, so you can see the flow chart structure here. Investment determining capital, determining output, determining employment rate, determining wages change, determining profit, determining interest payments, etc., and then back to capital again. I'm just hoping my system runs at a reasonable speed here. It's slowed down a bit. Let's give this a try. And what you get is a series of cycles that look like they're diminishing, look like they're going to die away, but then they start to rise on the other side. So if you're neoclassical and you want to believe systems head towards equilibrium, you're cheering on the first half and you're having a breakdown on the other side. And this is that fundamental complex systems nature of the behaviour of a capitalist economy. And ultimately those cycles will lead to a breakdown. Now, the strength of the model is that that basic phenomena is there, but the weakness is that the boom and the slumps are equally sided, and that's because it's a linear model, but also because I didn't have prices inside the system. So, including prices, you can still work from identities. The employment rate argument doesn't change because inflation turns up on both sides when you talk about nominal output. But the wages equation does. So you now have money wage demands, and if they exceed the sum of inflation plus growth in labour productivity, then wages share of output will rise. And the private debt ratio will rise if the rate of nominal debt exceeds the sum of inflation plus the rate of economic growth. So you need additional equations for the rate of inflation, variable nominal interest rates, and again I've used the simplest possible relationships, just a lag convergence to equilibrium, in effect doing what Fisher thought applied, and a lagged inflation premium for interest rates as well. So the price equation is something that I didn't bring it into my PhD because I'm never happy about imposing somebody else's equation. I always want to derive mine from first principles, and it wasn't until I built the monetary structure of Minsky that I could do this. So it's actually arguing that there's a lag convergence of supply and demand, which your Neoclassical would accept, except they'd want everything to happen instantaneously, of course. So I'll just actually bring up that model. This simply has output in nominal terms, and then production in physical terms, and then the price system equilibrates between the two. And if you simulate this model, you rapidly get convergence towards equilibrium and zero inflation. So very rapidly the system reaches equilibrium. But if I speed it up by making the capitalists much more responsive, so they adjust prices on a monthly basis rather than taking a year to do it, you don't get stability, you get instability. The faster you try to converge to a system, it's like trying to drive to your parking spot at work at 70 kilometres an hour, then slamming on the brakes when you hit the parking spot. Okay? You're going to go into somebody else's car. Okay? You're not going to stop on the spot. So it's totally wrong to believe fast adjustments means you get to equilibrium faster. But the price equation starts from that argument. The rate of change of prices is some lag convergence of monetary supply and monetary demand. And I start from monetary supply being price times quantity, and quantity being labour times productivity. The amount of labour being the wage bill divided by a nominal wage, and the wage bill being workers' share of output, where GDP is the turnover of money in the economy. So I've got a type of a velocity of money argument there. And with substitution, you finally get this expression. So that's where the whole term comes from. Of course, it's identical to Kolesky's markup equation. So fundamentally, another little unexpected discovery. Neoclassical convergence of price to equilibrium is the same in the long run as Kolesky's markup pricing equation. So with that done, I could then bring in a lagged an interest. There's the inflation term, the second equation there. But I've got the rate of interest being, again I'm trying to get my cursor to turn up on screen here so I can point at something. There we go. The rate of interest is the base rate plus a lagged response to the inflation rate if inflation is greater than zero. Otherwise it's the base rate. So that's effectively giving me a zero lower bound. And there's then a nominal, what you then get when you expand the model out is a nominal wages formula. So you see inflation is turning up here, and a nominal debt ratio effect. So again inflation turns up there. So the full model looks like this, and that's still a pretty simple model. There's only 6 equations, 1, 2, 3, 4, 5, 7 equations in there, and 4 system states. So there's an inflation-adjusted nominal interest rate, a first-order time-lag determining inflation affecting the wages share, and inflation affecting debt growth, and then finally a lagged response of interest rates to the inflation rate. So that's the overall model. Now to put that together as a Minsky model, we get some remarkable dynamics coming out of it, and rather than just covering, I think, the last 30 years, you can argue in some ways it covers the whole post-war experience. If I simulate this model, what you see initially are large cycles. Then the cycles appear to dampen down, a bit like the 1950s and 60s. Then with the rising level of private debt, which is being ignored by the neoclassicals, of course, you start getting rising cycles, which they blame on Keynesian demand management. And then finally the cycles start to disappear, and thank God the neoclassicals have taken over. We're going to reach equilibrium here, isn't that wonderful? Let's ignore the level of private debt, that doesn't matter obviously. We've got low inflation as well, stable employment, and all of a sudden, without warning, the economy collapses. Notice the employment rate starts falling off a cliff. Now, at the same time, the last person to know this is actually happening are the capitalists, because their profit share is cycling around that equilibrium. That's the third graph. And only when the rate of growth of debt goes totally exponential, given both deflation and workers taking the maximum wage cuts they'll accept, profit share also collapses. So the last people to know capitalism is over are the capitalists. Rather fitting, I think. So you get no warning. That's, again, just to repeat those graphs there. If you're looking at the employment rate and the inflation rate and you think a stable employment rate and low inflation are good, that's fine. If you're looking at what's happening in the industrial sector for profit, that also looks great. Only if you look at private debt can you see anything might be problematic. But of course the neoclassical theory tells them to ignore private debt, which is one reason why neoclassical economics is bad for the health of capitalism. So they didn't see it because they have meta-axioms that blind them to these sorts of phenomena. And Daniel Kahneman puts this brilliantly in his recent book, Thinking Fast and Slow. He said, talking about the concept of utility, theory, neoclassical idea of utility maximisation, he said, how on earth could such a nonsense concept survive for so long when so many counterexamples can be found? He said the only ways you can explain it is by what he calls theory-induced blindness. Once you've accepted a theory, clearly neoclassicals have accepted utility maximisation theory since the 1870s and arguably since Jean-Baptiste Say. Once you use it, it's extraordinarily difficult to notice its flaws. If you find something that contradicts it, you think there must be a good explanation for why that contradiction appears, that you just simply have to search to find the explanation and then you can stick with the theory. You give the theory the benefit of the doubt, trusting the experts you're part of, and therefore many have seen this and not actually realised that it doesn't work. They continue promulgating it. And the same thing applies here, of course, in macroeconomics, trying to understand why you should look at disequilibrium and why you should look at money. Now, Ansberger and Varoufakis did a great job of describing the major, what they called meta-axioms. So neoclassicals, if you criticise them for a particular approach, they'll always say, oh, you're out of date, we've already moved on from that particular idea. Well, Asperger and Varoufakis said, no, there are meta-axioms that they maintain, though the form changes. So for a start, they always begin from the individual agent working up. They never work from the systemic level down. So you have utility maximising individuals, profit maximising firms. If they talk about the government, they bring in rent-seeking regulators, etc., etc. They always start from equilibrium. Everything involves equilibrium. Any dynamic movement is movement from one equilibrium to another. Any deviations are due to shocks, and they only persist because of frictions. And the fourth one that they don't include, I'd say, is meta-barter. They see the capitalist system as fundamentally a barter system, and you can understand the macroeconomy without considering the monetary system whatsoever. In fact, if you look at money, you must be a banking mystic, according to Paul Krugman. So, given that, everything we've been through, including the crisis, are simply anomalies. They're not the main game. And one of my favourite little papers to have a laugh at recently, just as turned up last year, where the neoclassicals say one of the remarkable conundrums is why there's a business cycle at all. Because the output fluctuations of large economies should be small, because fluctuations in different sectors should cancel each other out and they should be independent. So there's no macro, there's no aggregate, and what you're looking at there must be fictional. That's looking at America's cycles in GDP, inflation and unemployment for the last 1.2 centuries. And when reality is an anomaly, your theory is the problem. And they're going to be the last ones who ever accept it. So the two crucial blind spots are this hang up on equilibrium and seeing the system as a barter economy. And if you look at Bernanke, of course Bernanke got the job of being chairman of the Federal Reserve on the argument that he was the expert on the Great Depression. He is not the expert on the Great Depression. He's an expert on explanations of the Great Depression that are consistent with neoclassical theory. Okay? And since the basic explanation is capitalism is stable, it must be somebody else's fault. And the somebody else, of course, was the Federal Reserve. Okay? He rejected Irving Fisher out of hand by saying that Fisher developed this idea of debt deflation, which influenced Roosevelt, but it was less influential in academic circles because of the counter-argument that debt deflation is no more than a redistribution from one group, debtors, to another group, creditors. Now, for a start, can you just see how naive this is? Because when somebody goes bankrupt, they don't give their money back to the debtor. If that were the case, nobody in Germany would be worrying about Greece going bankrupt because they'd get all their money back. It's just nonsense, but nonetheless that's his line. And Krugman, when he rejected me in that crazy debate we had back in, I think it's 2012, he said that Minskians and Austrians, interesting, I'm talking to Austrians about Minsky, view banks as institutions that have unique powers for good and evil, and he doesn't see it that way. Banks don't create demand out of thin air any more than anyone does by choosing to spend more. They're simply a way of linking lenders to borrowers, the whole loanable funds fiction of neoclassical theory. So they ignore and trivialise banks by using this loanable funds argument, where banks just introduce savers to borrowers and charge a fee. And they don't, banks that actually lend in neoclassical models, the one exception being the work of Michael Kumoff at the Bank of England, who's a good friend. And the only neoclassical I know who takes banks seriously. So if you look at Eggertson and Krugman in the paper they wrote back in the QJE, they had when they modelled the bank in the appendix, they had a patient consumer agent lending to an impatient investment agent, where the investment agent paid interest to the consumer agent and the bank charged an intermediation fee. So I've taken that and I've put it into a dynamic Minsky model where I have both of them doing that and by hiring workers, producing output, buying it from each other, selling to the workers in the bank, and then the investing agent changes the rates at which he or she repays and borrows. And if you run that model, they're right. If that's what banks actually did, you could ignore banks' debt and money. So the full model, in terms of a tabular layout in a stock flow consistent way, has lending being from the consumer agent to the investment agent, and in Minsky, all flows are shown from positive to negative. It's a bit like the engineering, the way engineers handle a flow of electrons. So notice there's no sign of debt there, because debt is neither an asset nor a liability of the banking sector in the loanable funds. It's an asset of the consumer sector and a liability of the investment sector. So to see debt, you've got to look at the system from the consumer's point of view in this model, and therefore what you have then is lending reduces the amount of cash that the lending agent has at the bank, but increases equally the asset they have, income earning asset of the debt that the investment agent owes to them. Now if I simulate this model, and I'll bring up Minsky and do that, if I can get my cursor to work again. Yeah. So now over here I can control the rates of lending, the rates of repayment, and if I simulate this model, notice the growth rate immediately stabilises at zero. If I increase the speed of lending and slow down how fast repayment occurs, tiny blips on the rate of growth of the economy, you can see the debt to GDP ratio rising dramatically and debt far exceeding the level of money in circulation. Now if I then speed up repayment, so repayment happens really rapidly and loans take forever, so you don't banks stop lending money, you get a plunge in the debt to GDP ratio, but no real change in the economy. Tiny blips exclusively caused by changes in the velocity of circulation of money. That simulation has been running for 265 years by this stage, and GDP throughout remains at 200. Okay, so you can completely ignore debt in this neoclassical fantasy called loanable funds. But what if we have this radical thought that maybe let's pretend that banks lend money? We do that, and all I've done to change from one model to the other is simply reallocate the asset of the debt from the consumer sector to say it's actually an asset of the banking sector. Waiting for my screen to redraw. And now, for a start, the growth rate is not zero. Notice it's positive growth rate. GDP is growing. The money supply is growing as debt rises because debt is creating new money. If you have an increase in lending and a slowdown in repayment, the growth rate goes through the roof. If you then have people repaying more rapidly and debt being extended more slowly, you have a collapse in the economy. So in the real world, changes to money have a dramatic impact upon the economy. You cannot ignore banks, debt and money. And the neoclassical fantasy is modelling a system that doesn't exist in this universe. So that gives us macroeconomic consequences as well. This is the final point. I know I've been talking very fast and very long, so I hope I'm not doing too badly on time there, Jacob. Good, okay. So this gives us another dilemma, because clearly in that model I've shown you a gigantic macro difference between loanable funds and endogenous money. But how do we reconcile that with the identity that expenditure is identically equal to income? And this has been a long-running debate between myself and some other post-Keynesian economists, of course. So I've just published a paper in the Review of Keynesian Economics. The issue just came out last month. That I hope finally ends that debate in favour of Minsky and in favour of me, in saying that change in debt plays an essential role in both income and expenditure. And in my past expressions of it, I didn't state income properly. So I did make some mistakes in getting to this particular argument. But just to imagine you can divide the economy into three sectors, S1, S2, S3. It really doesn't matter what you might think they are. And have expenditure from one sector on another, which is not financed by debt, shown as E subscript XY, which means expenditure by sector X on the output of sector Y, where that is financed by existing money. And I'm going to look at three situations. One where there's no borrowing, which you might call Say's law, but it's actually Say's law in reverse because its demand creates its own supply. Another where you can borrow from other sectors, which is loanable funds. And the final one where you can borrow from banks, which is endogenous money. So if you show the basic system, which is this no borrowing is possible, then on this matrix, the horizontal row shows expenditure, the vertical shows income. Of course, net income for any sector can be positive or negative, but in the aggregate, expenditure is identical to income. And the negative sum of the diagonals is aggregate demand, and the sum of the off-diagonal elements is aggregate income. So that's your expenditure is necessarily equal to income argument. So when you do the mathematics and you say what is expenditure and what is income, in this situation they're clearly equal to each other, identical. What about loanable funds? Well, in that case, sector 1 can borrow delta D from sector 2, which means sector 1's funds for spending increase by delta D and sector 2's fall by delta D. And sector 1 then spends the additional money it's borrowed in sectors 2 and 3 at the rates alpha and 1 minus alpha, and sector 2's capacity to spend falls by beta and 1 minus beta. So you put that together, and you then do the same summation. If you look at it without cancelling terms, you get this monster. And of course, you go through and do your cancellations, all the terms in delta D cancel. So you're back to exactly the same situation. So again, with loanable funds, you can ignore the change in debt. What about endogenous money? Well, now the borrower's funds are coming from a bank, and there's an increase in the bank's assets of delta D, which I don't show on the table because it would be far too messy visually, but it's certainly feasible to do it. There's an identical increase in the liabilities, and the delta D is spelt by sector 1 on the outputs of sector 2 and 3, but there's no reduction in the capacity of any other sector to spend because no other sector has lent in that sense. The bank has created additional money which sector 1 can now spend. So now when you take a look at your terms, and you add up aggregate income, which is the negative of the diagonals, and aggregate expenditure, the negative of the diagonals, and aggregate income, the off-diagonal terms, delta D turns up both times, and it does not cancel. So expenditure is now equal to change in debt plus the turnover of existing money, and so is your income. So both aggregate expenditure and aggregate income are non-debt financed expenditure, which is basically the turnover of existing money, plus the change in debt, which is both the creation of new money and new income and new demand all at once. Now obviously sometimes people can borrow money and not spend it. Okay, there'll be transient little differences like that, but normally your debt is only manifest when you spend it. So if you get a credit card, you might have a €10,000 limit on your credit card. You don't pay any interest on that until you buy something from a shop. And then if you buy a new computer for a couple of €1,000, your debt goes up by €2,000 and the bank gets €2,000, the firm selling you the computer gets €2,000 in income at the same time. So it's that phenomenon I'm talking about. And when you take a look at a flow of new debt over time, so it's DDDT rather than a particular instant, then I'm now going to show those sectors as representing bank balances. S1, S2, S3 are both the sectors and they're the amount of money in those sectors' bank accounts to begin with. And I'm using time constants now, so rather than talking about a blot of money, I'm saying a rate of flow of money with respect to time. So tau xy is the time dimension in years of the flow of money from sector X to sector Y. And because I'm now talking about a flow of money and a flow of debt, then I've got to have a stock of debt, and that stock of debt will be earning interest for the bank. So I've got to include bank equity inside there. And when I put it all together, there's a lot messier table. I haven't tried typing that in Word. I've just used MathCAD for this particular piece of work. So there are my sectors, which are the bank accounts, the amount of money in the banks. That's the change in debt. That's the interest being paid on debt. And then finally, when you sum the whole thing, you get the turnover of existing money plus gross financial transactions, not net. You have to include both income on debt and interest being paid on deposit accounts as part of aggregate demand, and the change in debt. So what you now get, in effect, is a dynamically correct version of Milton Friedman's monetarism. Friedman ignored the creation of money. The creation of money just fell out of the helicopters in his stupid model. Okay. When you do it properly with banks, money is being created by new debt at all times. So your corrected Friedman monetary equation is price times income is equal to velocity times money plus the change in debt. Whereas, of course, Friedman's left that out. And you have to generalise it as well to include capital gains, because most money that's borrowed into existence these days is done to finance asset purchases. So in that sense, you have to include the price of assets, change in the price of assets times the quantity of assets. And that gives me a causal explanation for a correlation data I've been raving about now for over a decade, which is this incredible correlation between change in debt and economic data. It only really gets that large when you have very large ratio of private debt to GDP, of course. When it's small, which is, by the way, the case that applies relatively in Germany, you don't get much of an impact from change in debt. You can therefore largely ignore it. Now, of course, this has all been ignored by the Neoclassicals, and this is quoting Bernanke again in this point, saying debt is just a pure redistribution, ignoring the creation of money. This is looking at the ratio of private debt to GDP across a few major countries for the last half century, more than a half century. So, of course, Japan was the first country to fall into a debt bubble. I'm going to try to bring my cursor back up on screen again. Here it is. Oh, damn, okay. There's this rising level of private debt in Germany and Japan, and then the decline. Austria, by the way, is the blue line. So you guys started from a substantially lower level of debt than America, private debt to GDP, but by the time the crisis hit and its aftermath, you've got almost an identical level of private debt to GDP that America has. America is the key, the red one there. You can see Spain's huge debt bubble, England as well. The only country with a falling level of debt to GDP throughout most of the 2000s is Germany, which is why Germany is an incredibly unreliable place on which to base your arguments about what the rest of the world should do. Now, no significant macroeconomic effects from that comment from Bernanke. Here's Japan, the correlation of change in private debt to unemployment since 1970 is minus 0.87. There's clearly a discontinuity in the data at 1998 or thereabouts, so the correlation is actually higher than shown by that, because that huge discontinuity affects the correlation coefficient. But not significant. America, correlation between unemployment and the rate of change of private debt since 1990 is minus 0.93. And they still ignore this stuff. That's why I'm using a satirical element to it. No significant correlation. God all bloody mighty. Austria, not quite as big, because you guys have some extra impacts from exports, as Jacob and I were discussing earlier, and also your side benefit from the euro, but even your correlation is minus 0.46 over that 20 or so year period. And the share market, again, as I said, this affects share markets and asset markets as well. And you have to look at the particular debt that's now used to buy shares. So looking at margin debt and this change in the S&P, the correlation in that over the last 25 years is 0.53. Accelerating margin debt drives change in asset prices, and it applies in real estate as well. The correlation between acceleration of mortgage debt in America and change in the price index for American housing is 0.77. No significant macroeconomic effects. Give me a break. So, oh, pardon me, but being all that, I normally need to animate everything I write, but I put that all on screen in one go. My apologies there. So what we have is a theory of economics whose meta-axioms make it impossible for them to understand capitalism. They're looking at individual behaviour, and they try to scale the individual up to the aggregate, which means they can't even see that complex phenomenon system of emergent behaviour. Now, I know emergent behaviour is a weird thing for people to get their heads around, but it really relates to relations between entities being more important than the characteristics of the entity themselves. And the best example I can give of that is water. The reason I can't see the beautiful view of Linz out the window here is because there's fog. Is there such a thing as a fog molecule? Does an individual H2O have a fog state? Does an individual molecule of H2O have a water state? Is there such a thing as an ice molecule? How about a snow molecule? The answer to all those questions is no. There's no such bloody thing. The only way you get fog, or steam, or water, or ice, or snow, is by the interaction of water molecules, H2O molecules. So that is an emergent property. We live in it all the time. That's your classic case of an emergent property. Therefore, neoclassicals would attempt to define water by talking about the water state of a molecule. It has no such state. Okay? You've got to talk in relations between entities. That's the major problem they make. Secondly, they're quite happy to have unrealistic assumptions. They argue that that's, you ignore the trivia, the minutiae. What they're actually saying is we can have absurdly stupid structural models of capitalism and still model capitalism, which is what Ptolemy was doing with astronomy. Okay? Before we discovered that, no, the Earth is not the centre of the universe. And we rotate around the sun, not vice versa. So you can have an accurate model, and Ptolemy's model was quite accurate in predicting where the planets were going to be. But it was completely wrong. So the accuracy of predictions is not a justification for a theory. You must be structurally accurate as well. And what they're defending by saying unrealistic assumptions are okay is saying we don't need to model the structure of capitalism accurately. Yes, you do. And when you do, you see most of its behaviour. And that behaviour is fundamentally non-equilibrium. So again, thinking about equilibrium and imposing equilibrium, even the DSGE models are based on the Ramsey growth equation, which has an unstable equilibrium. They solve it by presuming there's a social planner who can jump to that who can work out what the equilibrium path is to get there in the vast future and readjust consumption today so that we'll invest at the right rate to reach that future bliss point. And they still do the same crap. That's the only way to describe it. The same crap underlies their vision of DSGE models, where they presume each individual agent has the intelligence of a central planner. Great stuff. One of the great ironies of neoclassical economics is they have to imagine a socialist runs it. And it's also fundamentally a barter model of capitalism. And to me, a barter model of capitalism is a model like a model of birds without wings. There ain't no... Try to explain how a bird flies while ignoring that it has wings. That's really what neoclassicals are trying to do. Now, all these choices, when they were first made by the founders of neoclassical economics, were reasonable to those at a hypothesis 150 years ago. It sort of made sense to say utility drove behaviour and maybe utility affected price. And they chose static tools because they did not have dynamic tools at that time. And they thought in the 20th century their successors would build these dynamic tools. We've gone right through the 20th century and they're still obsessed with equilibrium. They're still ignoring genuine dynamics. So it's time economics grew up and learned how to do dynamics properly. And I know that I'm talking partly to people from a philosophy of science area here rather than economics, so I can proudly say, if you want to come and learn economics that way, come to Kingston. Thank you. There was a problem with the sound. That's it. That sounds good.
Hello. Yeah, many thanks for this great talk. We have still 15 minutes left or so for discussion. So if you have any questions, remarks or comments, the floor is open. I'll start there.
Thank you very much for this talk. I recently moved. I did not know to get rid of my potential business that I had to move to a different planet in the universe. But what I've seen here with this transient move from slowing down to an explosion is also known in the ecology literature as a critical slowing down. Are you aware of this?
Oh yeah, I mean in critical points like Tom arguments about cusps and catastrophe points. Yes. Yeah, I think that's one way to see it, but it's also truly it fits the Pomo-Manivelle structure. And that's the first thing. When I was doing mathematics while I did my PhD, I used it as an excuse to do pretty much a degree in honours mathematics while I was doing my PhD. And I had this brilliant lecturer, Bruce Henry, who was, funnily enough, he's the brother of the then Treasury Secretary of Australia. And Bruce, as soon as he saw it, said, that's Pomo-Manivelle. So we went and looked and saw what the Poe-Maniville structure was. So it's more Poe-Maniville than it is Thom. But Thom is another way to look at this sort of cusp catastrophe stuff, because one of the best people who are writing on that is Barclay Rosser. So if you want to take a look at this idea about a cusp catastrophe and so on, then that's another way of analysing it, sure. Yeah, that's right. THOM.
In your models, you rely on Minsky's FIH, but there's a huge difference between Minsky's FIH and your model, because you say increasing of private debts takes a major role for this process, and Minsky says the increasing level of indebtedness of private companies is a major. Can you give an explanation why you switched from Minsky to your own model in this term? And the next question is, how do you define private debt? I mean, it's a difference if you take debt à la blanche as a creditor, private creditor, or if you buy a car or a house, or if you can cover it by insurance, for example.
Okay, I was modelling Minsky. That model has absolutely no household debt in it. So in that sense, I'm saying here's Minsky's hypothesis precisely in the model. Okay, but the real world, as you say, there's been a large amount of household debt taken on as well. So the rise in corporate debt pretty much finished in the mid-1980s or late 1980s after the stock market bubble of 87. And from that point on, distant debt was definitely rising from 1945 in America right through to 1987. From 87 on, it's fluctuated. It's been up and down with the cycle, but it hasn't risen past a maximum scale. And that's where I think you've got to have to also include the active role of banks in this, because banks make profit for themselves by creating debt. And because it's so easy to create money and create debt, they are always looking for somewhere they can market debt to. So banks found they could no longer market the debt to the business sector. That growth market was gone. So where else was there a growth market? Where else were there low levels of debt that they could actually encourage to high levels of debt? It's the household sector. And that's tied up again with real estate, because real estate, but also shares, but fundamentally real estate, because households, when you look at households borrowing for consumption, that's also relatively cyclical and stable. There's no particular trend to the level of not unsecured debt to GDP in the American or the Australian or most of the European data. There's no particular trend. It cycles up and down. The one thing with the trend is borrowing for, particularly for houses, but also for shares. There's been an increase in the gearing for mortgage debt in every country in the world except Germany. Okay. And again, that relates to Germany's far better real estate system. I don't want to emulate Germany's auto-liberalism or anything like that, but I'd love to emulate Germany's rules about rental rights for renters, and the terms of rental agreements and things like that, which means there's been no particular pressure on households in Germany to think about, I better buy this place, A, for two reasons. A, because the price is going to rise if I don't buy it now, which means you get encouraged into that whole borrowing bubble, but B, because the landlord can kick me out with 6 weeks' notice or 2 weeks' notice, and I therefore have insecurity of tenure as a renter. So the combination of the insecurity of tenure as a renter that applies in virtually every country except Germany gives people as a household an incentive to buy rather than rent. And then once you have a bubble taking off in house prices, which is driven by people taking on more debt, then that tends to be a positive feedback process which reaches a peak and then collapses. So that's the major difference between what Minsky spoke about and what happened in the real world. When I include that in my model, I get a faster rate of breakdown. Okay. Yeah. Can you just read the microphone? I think it's good for the sound. Yeah.
But I think the reason, you always say exact Germany, because the reason is the legal framework. When you want to buy a house in Germany or real estate in Germany, the bank can also get your money from your income. So, but in the USA or in the UK, that is only covered by the real estate. But in Germany, the banks can also take the money from your income, and that is the reason why the Germans are more cautious on indebtedness than in other countries. So I think it's also a question of the legal framework.
Yeah, that's a good point. That's a good point. The whole combination of factors and the legal framework being, I think the legal framework that renters have so much better rights here and they can hang on for longer, that's positive. But as you say, the alternative rent to it, when people go from renting in America to owning in America, they think that they've got, ultimate ownership and they can go bankrupt. It's only 13 states in the USA, by the way, where that jingle mail thing applies, where you can just hand the keys back, give the house back to the bank, and then you have no bankruptcy impact upon you apart from your inability to borrow. The other states all have what applies in England, of course, where if you go bankrupt, then the debt you owe to the bank is still there until you go through the bankruptcy process. But you're right, that's a major difference, and that would make you more cautious about taking on debt, and caution about taking on debt is an extremely sensible thing.
Okay, time for a final round of questions. 1, 2.
My interest is in change and resistance to change. Given that money creation, debt, money has been excluded from conventional economic models, from your experience, is that due to an oversight or illogical thinking in the assumptions underlying economics, or if it's vested interests which are keeping money out of the equation? Because if it's purely an oversight and economics wants to consider itself a science or evolve into a science rather than religion, then we're just dealing probably with the egos of the economists to deal with. If it's because of vested interests elsewhere, perhaps in the money system itself and the control of money, then it's going to be a bit trickier to change things.
You're right, and I disagree with you.
Can we get a second question?
No, well, that's a good one. Actually, this is going to go up on YouTube, so it's nice to get them straight away. It's not vested interests. And if it was vested interests, we could buy them out. Okay? It's easier to change vested interests than it is egos and beliefs. Because if people believe something, they're going to risk their lives to do it. You know what I'm talking about here. Okay? And in an economic sense, the same thing. If you actually believe something like this, it's much, much harder to change than if you're paid to say it. So I think it's definitely, these people, it's not a case of self-belief, of being bought out by the financial sector. They're strongly influenced by the financial sector. And they certainly benefit from it and all this sort of stuff, and they get paid to say that Iceland's banking system is fantastic, and it then collapses 3 weeks later, that sort of thing, for sure. But fundamentally, they're paid to say what they believe when they're paid something. And most of them do it for free. And that's why they're so bloody hard to get rid of.
So it's a Kuhnian problem, not a Gramscian.
Exactly.
Thanks for the presentation, Steve. I have a very short question, which is, given your theoretical background and your model, can you say anything about the future of the euro area? What is your take on that?
I think the euro, I described the euro in my first edition of Debunking Economics as a collective suicide note by Europe. And I stand by that. It was an insanely bad decision to have a financial system built without a central bank for the transfers, and that's what Yanis has been arguing very eloquently and being totally ignored by the other finance ministers when he was finance minister. Unless you brought in a form of transfers, fiscal transfers, then it was never going to work. I think the chances of fiscal transfers now are less than zero. After the whole experience, there's no way it's going to happen. The only way out of this is to break the euro up. And I think the best thing would be for Germany to leave. And because Germany's trade surplus at 7.5% of GDP has been solely driven by the euro. That would force Germany to change. But they're not going to do it because the benefits is too damn high, and the ordoliberalism means they won't even consider it. The difficulties of a country leaving the euro are enormous for a small country like Greece. That's why Yanis Varoufakis wouldn't consider it, though he did start planning for it and he didn't get the carry on to build a parallel currency system. France might leave. I think my main worry about all this is that it's more likely to be done by the extreme right than the extreme left. Both the extreme right and the extreme left are benefiting out of the chaos the euro has caused. And the extreme left tends to try to be reasonable and negotiate and discuss. The extreme right bashes your balls and changes the rules and is proud of it. So my real fear is that the breakout of this will be done by an extreme right party, and that will then justify the rest of their agenda because they'll make the economy revive. And in that process, everything else they do will get legitimised as well. It's the recipe that Europe has tried once before.
So still some work left to do. Time is over. Many thanks for all of you for your attendance, and many thanks to Steve for his really kind talk. Thanks a lot for coming this far.
Thank you.